Hi there, I'm Kelly Buckley, founder and managing principal at Spectrum Financial Alliance. It's understandable that the last few years have been turbulent and have led to doubts about your financial progress, the markets, and even our government. But remember that this nation's founding fathers and mothers established a structure for our success, enshrined in our Constitution. By following that framework and engaging in proper planning, anyone in our country can spend within their means and save and achieve financial success and wealth. Despite the economic and social challenges we're facing, including the recently passed COVID-19 pandemic, ongoing political infighting, perverse business destructive government policies, and equally illogical healthcare decisions, I believe it's still a good opportunity now to assess how our client returns are doing. But before we delve into the numbers of our client returns, let's talk about what is an appropriate goal. At Spectrum Financial Alliance, we've always believed that clients with a growth and income portfolio, which is the majority of SFA clients, should achieve returns of approximately 8 to 9% in the long term. For clients falling into our growth model risk tolerance category, long-term returns are a little higher, around 9 to 10% should be expected. Balanced and capital preservation accounts usually fall below those figures, generally at or around 6 to 7% annually. Achieving higher returns, folks, entails accepting slightly higher volatility in your day-to-day portfolio movements. That's your trade-off between risk and reward. Therefore, our firm's targeted returns, depending on a specific risk tolerance of a client, should range between 6 to 10% or more. Expect that level of return over the long term. Now, it's important to note that when I say long term, that doesn't mean a year. In the world of investments, as in life, we all experience ups and downs. Things don't always go as planned and valuations can deviate. It's during those challenging times that perseverance and character shine. A long-term return should be assessed over a 3 to 5 year period, or equivalent to one market cycle, not annually or quarterly. That's not how good investment returns are created. So, as of June 21st of this year, our firm's trailing 1 year return, including all accounts and after deducting cost, stands at an impressive 12.72% per year. Over the trailing 3 years, our return net of cost is 10.64% annually. As we used to say in the United States Air Force, that's not bad for government work. Considering the dysfunction we've witnessed in our government and the flawed decisions of our national health authorities over the past 3 years, those returns are really quite good. On October 10th of last year, our firm projected an exceptionally strong fourth quarter return for our portfolios, which we weighted toward value styles and which closely followed our firm's concentrated and predictive methodology. We also projected that strong upward movements could be expected moving into and throughout the election year of 2024. True to our prediction, in the fourth quarter of 2022, our firm's portfolios achieved a net return of 18.68%, which surpassed the S&P, NASDAQ, and Dow Jones indices by a wide margin. From the last quarter of 2022 through the first quarter of this year, our firm's clients averaged a total net return of 21.99%. During that same period, the Dow Jones Industrial Average accomplished a gain of only 16.8%. Both the S&P 500 and the NASDAQ lagged behind that down number. To truly appreciate these numbers, you must understand they were achieved despite government policies that clearly discouraged economic growth. These policies included 9 interest rate hikes by the Federal Reserve since March of last year, amounting to a total increase of over 5%. Additionally, there were capital destructive federal government policies, significant increases in regulatory activity and business compliance costs, tax increases, and a deliberate undermining of our nation's ability to produce our own energy. All these factors contributed to an epidemic level of inflation. Yet our firm correctly predicted the outstanding returns that occurred in this very difficult environment. We were a lone voice, and we were heard and correct. Now, as we enter the second half of 2023 and approach the upcoming presidential election year of 2024, our firm projects that the Federal Reserve is unlikely to raise rates, even though it was recently suggested by Federal Reserve Chairman Jerome Powell during his congressional testimony. If the Fed does raise rates, the rate increase will be small and relatively inconsequential. Instead, we expect within the next 6 to 7 months for the Fed to actually begin reducing interest rates and also to reinstate some monetary stimulus to support the re-election of currently serving politicians. Now, folks, that statement is not a statement of partisan politics, but merely part of the Federal Reserve's historical policies. During the final 4th year, out of 15 of the last 17 presidential election cycles, the Federal Reserve has actually decreased interest rates. In the other 2 cases, they kept rates unchanged. This economic fact reflects that despite the Fed's supposed independence, it has historically aligned its actions with whatever political party is currently in power. So this impending interest rate reduction should not come as a surprise when it occurs. The easing of monetary policy will likely translate into gains in the equity markets again, but will continue to negatively impact bond prices and returns. You know, it's said that the market climbs a wall of worry, and throughout our economic history, this has proven true. Our advice to you is not to falter. Aim for the best and expect favorable outcomes, as things have always worked out fine long term. To achieve double-digit equity market returns, which can double your capital over an approximate 7-year period, we must accept some volatility. Economic history is on our side, and we wholeheartedly embrace it. We hope you do too. If you have any questions or concerns, please don't hesitate to call us at 859-223-6333. Remember to look up, for that's where our strength comes from. God bless.